So there's a lot of confusion out there about the housing market right now, and frankly, it's difficult to know who to believe. But let's start here. Don't listen to the national news if you want to understand our local real estate market. This isn't a political statement of any sort, but more of a reflection of the nature of the real estate market. National market data is exactly that. Data for the entire nation, not our local market. One thing to make clear about real estate, it is what we call a hyper-local market. Market data from Los Angeles, Omaha, Dallas, Miami, and Charlotte have almost no impact on Indianapolis. In fact, Marion County data is going to look different than Hancock and Johnson County. And it's going to look really different from a rural county in northwest Indiana like Newton County, for example. Just as the housing crash of 2008 destroyed housing markets in places like Las Vegas, it had a far lesser impact on more stable markets like the one we enjoyed in central Indiana. Did the 2008 housing bubble send reverberations throughout the nation and world that affected our local markets? Sure, but certainly not to the extent that was seen in other locations that were at the heart of that crash. So then, what can we say about our market in central Indiana today? There's no doubt rising interest rates have slowed the market down from the frantic pace it had built throughout 2020, 2021, and 2022. And don't tell anyone I'm saying this, but even as an agent that only makes an income when his clients buy or sell a home, the slowdown is good for almost everyone. Housing price increases were out of control. In central Indiana alone, the year-to-date median home price rose from $180,500 in January of 2020 to nearly $280,000 in August of 2022. That's a 55% increase in just 31 months. What? Don't get me wrong. Increased property values are a good thing, but wild and out of control growth in any economic sector is almost always bad. We call that a bubble, and it's generally the result of irrational or overly competitive consumer and investor behavior. And as we learned in the not too distant past of that 2008 housing bubble crash, or the slightly more distant dot-com bubble bust of 2000, bursting bubbles are very bad, especially when it comes to something as important as housing. But is that what we have here in 2023? It doesn't appear so. First, to get some things straight. 1, has the housing market slowed? Yes, most definitely. Well, most recent data is from the past February, one of the slower months in real estate. Year-to-date closed home sales are down 63% from this time in 2022. Ouch. But is this surprising? No. The Fed prompted interest rate increases last fall for this exact reason, to cool buyer demand and slow down sales numbers to battle inflation. Mission accomplished, I guess. Number 2, have home prices fallen? Yes, and maybe no. The year-to-date median sales price in February 2023 was $275,000. This was actually a 14% increase from the $250,000 median price in 2022. However, monthly median sales prices have actually ticked down slightly from their high of $285,000 in September of 2022. So in this respect, prices have fallen, but it is difficult to say if this is a partly seasonal or part of a larger trend. Only time will tell on that. Number 3, what about these recent bank failures? That can't be good, right? In short, no, of course not. A banking crisis is never a good thing. But will it result in an economic catastrophe? Without getting too far down in the weeds, another post for another day, probably not. Well, some investors and business startups will need to get bailed out and have been bailed out. The lending industry on a whole still seems to be okay, at least okay enough for the Fed to recently approve another slight federal funds rate increase. So back to my earlier question, are these signs of a housing crash? Almost certainly not. The only reason that question even comes up is because of the chatter about it online and in the media. First, as my old history students learned from me, I hate the phrase history repeats itself, because it doesn't. I'm more in agreement with Mark Twain's assessment that history more often rhymes. This is not 2008, and while it might be appealing to compare 2023 to 2008, and even fair in some cases, this is not a repeat. As is usually the case with history, 2023 has more differences from 2008 than similarities. The starkest differences, of course, thanks to the Dodd-Frank Act. We don't have wholly irresponsible, if not criminal, lending practices prompting this downturn. If you've watched the movie, or better yet, read the book, The Big Short, I encourage you to do so. You'll see the level of irresponsibility of the 80s, 90s, and 2000s that led to that mess. Were mistakes made this time around? Almost certainly yes. And I'm assuming we'll learn more about those in coming years. So what do we have then? Well, first, we simply don't have the explosion of that bursted bubble like we did in 2008. It's more of a slow release of air. We don't have thousands and thousands of people with bad or questionable credit, wild adjustable rate mortgages, and $100,000 or $200,000 underwater on their mortgages like in 2008. For people who bought their home last summer, they probably aren't going anywhere anytime soon. If they must sell for some reason, then there's a possibility that they may lose $10,000 or $20,000 on the value of their home. And maybe if they bought their particularly competitive home in a particularly competitive market. But those are fairly rare situations, and add to it to have to move that quickly. It hurts those individuals, but it isn't a market-wide issue like the problems of 2008. In most cases, if those homeowners stay where they are at, the market will rebound and they will make up their losses in a couple of years at most. And it may even be less. And they get to enjoy their home in the meantime. Further, for homeowners who have owned their home for 7 to 10 years or more, they have still made a ton in increased home values. Did they possibly miss out not selling last summer? Possibly. But I also missed out buying Apple stock when it was 25 cents per share in 2002. It's $160 per share as I say this. That ship has sailed. But again, it's important to note that home values really haven't crashed. Well, the median prices have declined for now. I think we're going to see that level out over a bit this summer, especially if rates continue to decline. At the end of the day, home prices have likely leveled off, not declined. So what does this and what does it mean for buyers and sellers? Well, first of all, if you're a seller, there are still a ton of buyers who want to buy, as the inventory of homes for sale is still low, although increasing as of late. Are you going to get as much for your home as your neighbor did in 2022? Maybe. You might even get close. It depends. If your neighbor had one of those situations where there were 10 buyers competing for that home, there's a good chance your neighbor's house was overvalued for the market we are in right now. And if you try to force the higher price, well, those are the houses that aren't selling at this moment. But most people don't realize that most homes are still going for list price or higher right now. So are you going to make a really strong return on your investment you made when you first bought your home? As long as you didn't just buy your home in the last few years, almost certainly. And I'm always happy to do a free comparative market analysis on your home if you're curious about the value. Just contact me if that's something you are interested in. Now, if you are a buyer, as I mentioned, the outrageous home prices have cooled, meaning even though interest rates are higher than they were last year, your money may still buy you more than you think. Plus, interest rates have actually been ticking down a bit over the past few weeks, even despite the recent increase in federal funds rate. Go figure. Plus, lenders are doing a lot of buy-down programs to buy down your rate for a couple of years with the hope you can refinance when interest rates settle in down the road. I'm happy to set you up with a lender or two or three to discuss this in order to see if now is a good time to buy. Now, just a note, I will tend to use median values in my posts as opposed to average. Average is probably more common because people are more familiar with the term, but it's generally less of a valuable statistic. Median is the true middle of a set of values and less influenced by large outliers, which is something that we definitely see in the housing market. Averages can be more influenced by those rare, more dramatic events, such as homes selling for twice their asking price. The data that I used here was also covered by Mybor Realtor Association, which includes Boone County, Brown, Decatur, Hamilton, Hancock, Hendricks, Johnson, Madison, Marion, Montgomery, Morgan, and Shelby counties. You can check out my sources on my blog, and of course, if you have any questions or comments, feel free to leave them in the box below.